Praveen, am I audible? Can you hear me? Could you please say? I think there are only two students now. Hopefully they will. Niranjana says yes, but I'm asking about Ravin. Ravin, can you hear me? Could you please say? I think Ravin is having some sort of. Okay, now it's okay. Fine. Ravin, can you hear me? Could you please unmute and say whether you can hear me or not? Please unmute, Ravin. Please unmute. I would like to ask you questions about
Yes, sir.
which institution are you studying? I know, but for the sake of other students, I'm just asking just to know about how is the classes in Tamil Nadu. I know you are from Tamil Nadu, but I want to hear which institute are you studying, Ravin?
Sir, SOE Global, Chennai.
Yes. Chennai. Okay, fine, fine. Which are all the papers you have completed, or what's your plan for the upcoming sessions?
So this is my first paper FM, sir. First exam.
Okay, you have already told me. Now I got it. This is your first paper. How do you feel? Is it easy or is it difficult?
Sir, it is easy only, sir, but I have over fear. So that,
No,
but
no,
over
no,
no work, sir.
no need of fear, Ravin. The max, always think about what will happen to the extreme. To the extreme, we will fail only. Okay, that only will happen. So we need to understand that failure is also a part of this game. Okay, when you come to a course like ACCA or CA, failure is also a part of this game. We need to understand that. We need to adapt to that reality. Because even I have failed many times. I have not failed in FM, but I have failed in AA. I have failed in papers like PM and even in tax. I think I have failed. So I have failed 5 or 6 times. Maybe I didn't. I don't know that much time I have failed. It was back then before 5 6 years. Uh, okay, that was the scenario. We didn't have this much of a wide variety of institutions and different faculties and all. We had only limited resources available to us. There isn't this much videos in YouTube. There isn't this much free revision sessions available. So we had that difficulty in our exams. So even I failed many times. I woke up at 6 o'clock and I had to look at my phone and see that I have failed in papers. That was a horrible situation. Even though later I came to know that these all are part of this course. Definitely, there will be failure. Okay, I haven't seen so many people who have cleared all papers in first attempt, or only very few. Okay, maybe 1 in 1,000 or 1 in 10,000. That much only people always pass at first attempt. So we need to understand that. Okay, do you know what is the pass rate of FM? What was the pass rate last session? Do you know?
Sir, around
Or
50%.
around 50%. Last time it was 52%. Okay, but we need to understand that it's only a global pass rate, not a specific pass rate in India or a specific pass rate in a certain area or institution. It's a global pass rate. We need to consider other country people also. Okay, there are in most cases in India the students fail due to the lack of knowledge in theory. Indians normally don't like theory and all. Mainly other country people. They are very good in theory. So it's equally the pass rate is equally divided into all other countries. So it's a global pass rate only. We need to understand that reality. It's a global pass rate. Anyway, it's not an easy paper. It's a challenging paper, I would say. It's a challenging paper, and it's not something that is very difficult, but it's a moderate one, an average one. It's not that too easy. Also, we do have a wide syllabus compared to other papers like AA, PM, and FR. Okay, tax is always a bit more lengthier, but even though I would say this is one of the papers in which the syllabus is more wide. We do have a lot of equations. Maybe you can count up to 200 or 150 equations itself. There are n number of equations in which we need to study around 50, 60 equations. Okay. There are other equations also, which sometimes we need not study, but there are equations in the syllabus. Okay. There are a lot of equations in the syllabus, which we need to study. Anyway, you will be knowing that we will be provided by a formula sheet in the exam. Okay. There are certain equations in the formula sheet also. Okay. You'll be knowing that, I know. But
I know,
Revin,
sir.
have you,
Sir, also.
sorry,
I know, sir. Former should video.
formula sheet will be there. Have you completed your mock exam?
Yes, sir, in my institute.
In your institute, you have completed.
Yes,
I
sir.
want all of you, actually, I want you to write at least three mock exams before your exams.
Yes, sir,
You
written,
need,
sir.
okay, you have already written three mock exams.
Yes, sir. Yesterday only last mock written.
Yeah, that's really fine. Okay, how much did you
Yes, sir.
score?
First mock exam 56%, second 55. I think third will be 70 or 75 plus will get sent.
Yeah, okay, that's really good. Okay, you mean you wrote 200 marks or 60 marks?
No, no, sir, 100 marks, like real
100 marks,
exam.
real exam. Okay, fine. And that will be really fine. But you need to understand that the mock will be a bit more easier than the main exam. The mock exam
Yes, sir.
will be easier than the main exam. If you want good marks in the main exam, you need to score at least a score of around 60 plus. Okay, if you can continuously score a score of around 60 plus, then you will definitely pass in the main exam.
Okay, okay,
Okay,
sir.
that's the actually that's a reality. Okay, main exam is will be a bit more tougher than the mock exam always. I have seen students who are scoring around 70, 80 marks in mock exam, and sometimes they will also end up in failing in the main exam. So that we need to understand the reality, it's mock exam will be easier compared to the main exam. So we need to work harder anyway. Okay, it's not the time to settle. So that we got marks in mock exam, and we will think like, oh, I'm okay. Don't think like that. We need to score more in main exam, so we need to work harder. Anyway, I was waiting for some others also to join, but uh, there isn't many. So I would like to start, by the way. Okay. I hope they will join later. Okay. Can you see the screen now? Is the screen visible to you? Could you please comment whether the screen is visible or not? Revin or Niranjana, anyone? Okay, Revin says yes. Anyway, let's start. We will be discussing about risk management today. Risk management today. I need you to comment, okay? I need you to either comment or just unmute and say. I want all of you, both of you, to participate in this question answer. Maybe it's like a question answer section, but don't worry. It will be okay. Even if you don't know, try to attempt it. Okay, those who attempt it, they will definitely will remember the answer in the exam. Last session, I had a student. She was really good. She used to. She was not that much brilliant, but she used to try to answer all my questions, and she ended up in good marks. She got around 74, which was one of the top marks in the country. She wrote the exam. Unfortunately, she was writing in the second attempt. So earlier she sat in some other faculty's classes, and she wrote in the second attempt only, so that she didn't got any rank. Otherwise, she would have got some ranks. Anyway, I want all of you to participate so that it will be like a conversation only. Otherwise, I will be like getting bored. Okay, anyway, risk management. In risk management, how many chapters are there in risk management according to your Kaplan textbook? According to Kaplan textbook, how many chapters are there? Could you please say? According to your Kaplan textbook, how many chapters, how many topics are there in risk management? Okay, I want you to comment, right? Okay, so try to comment. Anyway, there are two chapters. One chapter is named foreign exchange risk, and the other one is named interest rate risk management. Okay, interest rate risk management. Okay, as a company, we would always expose it to. Okay, if you are doing business in some other countries, we are a multinational company. We would always expose it to foreign currency exchange rate. Okay, that's a reality. Every multinational company, or if you are working, or if you are trading in some other countries, we will be exposed to foreign currency exchange risk and probably interest rate risk if we have taken any loan, or if we do have some deposits. Okay, we will be exposed to interest rate risk. Anyway, first of all, we will start with the chapter foreign exchange risk, forex, I would say, foreign exchange risk management. Certainly, suppose the current India UAE exchange rate is rupees 24, around rupees 24 per AED. Okay, uh, suppose let's take an example of a boy named X. His name is X, and his father is working in UAE. So his father is going to send him 5,000 AED every month. Okay, X receives 5,000 AED from his father every month. So what will happen to X? Whatever happens, X will get 5,000 dirhams from his father. Okay. Then my question is, what will happen to X if the rupees AED exchange rate went down? Because I say the Indian currency appreciates. Okay, if the Indian currency appreciate, if the Indian currency appreciate, it would become like 25 per AED. It will increase, no? Okay. Is this appreciation or depreciation? It's actually depreciation, not appreciation. It was my mistake. Suppose the Indian currency appreciate, which means we need to give only 23 rupees for 180. We need to give only 23 rupees per 180. My question is, will X get more money or less money? His father will send 5,080. He's in India, right? So will he get more money or less money? Please comment. If the Indian currency appreciate and it becomes 23 rupees per AD, we need to give only 23 rupees for 1 dirham. Will X get more money or less money? X will definitely get less money only. Now it's 24 dirhams, no, 24 rupees per AD. If it becomes 23 rupees per AD, then he will receive only less money because his father will send only 5,000 dirhams. Then if it converted to Indian money, he will receive 22 rupees for 180. Later, he had received 24 rupees per AD. Okay. Anyway, he will make definitely uh, receive less money only. Okay, he will definitely receive less money because the rupees got appreciated. Okay, this is appreciation. Actually, the value went down, but this is appreciation because we need to give only nearly less money for 1 dirham. So this is in terms of rupees. This is appreciation, not depreciation. This is appreciation. Okay. Sometimes students get confused by the word appreciation, depreciation. Okay. Is it strengthening or weakening? Is it rupees strengthening or weakening here? It's 24 rupees. Then it becomes 23. It's went down to 23 rupees per ID. Is rupees strengthening or weakening? Kindly comment. Kindly comment, Revin, Niranjana, anyone. Is Indian rupees strengthening or weakening? If it goes from 24 rupees to 23 rupees, say whether it is strengthening or weakening. Strengthening or weakening. Kindly comment. Kindly comment, Revin, Niranjana, anyone. Is Indian rupees strengthening or weakening? If it goes from 24 rupees to 23 rupees, say whether it is strengthening or weakening. Kindly comment. Kindly comment, Revin, Niranjana, anyone. Is Indian rupees strengthening or weakening? Say whether it is strengthening or weakening. Comment. See, even if it is wrong, don't bother. Just comment only. That's how you learn. It's Revin says it's weakening. It's not weakening actually. Rupees is strengthening because earlier we need to give 24 rupees for 1 AD. To get 1 AD, we need to give 24 rupees. Now our rupees are strengthened. We need to give only 23 rupees for 1 AD. Okay, it's strengthening actually. It's appreciation, not depreciation. Okay, our rupees is getting stronger. Okay, it's strengthening. Stronger in a sense, we need to give only less money for 1 dirham. Suppose if we need to give 100 rupees for 1 dirham, our rupees will be like really what weak. Okay, because we need to give 100 rupees for 1 AD. That's really weak, no? So it's simply this is simply strengthening. Okay, strengthening. Anyway, that's a start. That's a start to the subject. Anyway, let's discuss about risk. What are all the 3 types of risk? Please comment down the 3 types of foreign exchange risk which you need to learn in your FM. Anyone among the 3, please say. Please comment anyone among the 3 type of risk that you will be facing. That you will be facing. Please comment. What are all the 3 types of risk that we'll be facing? Transaction risk, very good. Niranjana, it's really good. It's transaction risk, then transaction risk, then translation risk, economic risk. Yeah, you guys are doing really nice. Okay, it's economic risk and it's transaction risk. Sorry, translation risk. Okay, I would give you a hint. Transaction risk is a kind of risk that will happen when we involve in a trade. Okay, commercial trade. If involved in a commercial trade to some other countries, then definitely transaction risk will be there. Okay, or else if we borrow or lend money to some other countries, definitely there may be transaction risk will be there. Okay, then what about economic risk? Economic risk is a kind of risk that will affect the economy as a whole. Okay, that is affected to the economy as well. Suppose some kind of war occurs. If you do have some asset in some other countries in which we get money, and sometimes if a war occurs in the other country, then it will affect our cash flow, right? It will affect our cash flow. Then it's called economic risk. It's affecting the economy as a whole. So economic risk is you can simply just looking at the scenario, you can simply say that this is something that happens in a wider perspective, not to our specific company, or it's something like and risk that is happening to a wider area. Anyway, that's economic risk. Then there is translation risk. Okay, translation risk is only an accounting risk. There is no cash flowing back. It's only an accounting risk. If we account the foreign currency, there is a probability that there is a risk occurring. There can be a risk occurring. So it's called translation risk. It cannot be there cannot be a cash flow impact. So translation risk is an accounting risk only. There won't be any cash flow impact. So there are 3 kind of risk: transaction risk, economic risk, and translation risk. So we need to reduce or eliminate all these risks. In FM, we are learning to reduce or eliminate transaction risk only. Only transaction risk we are trying to reduce the risk, or we are trying to eliminate the risk. Only transaction risk, not about economic risk or translation risk. We are reducing transaction risk only. Anyway, what is the name? What will we call the term? The term of the process in which we try to reduce or eliminate the risk. What is the term? Term of the process of eliminating or reducing the risk. We call a name for it. What is the name? Please comment. What will we call? What will we call the process of eliminating or reducing the risk? What is the method? Revin, can you say?
Sir, your voice not audible, sir.
Okay. I think there are some kind of okay. Actually, a call came, so that some network issues will be there. Anyway, now am I audible now, Revin? Okay. Then I'm asking, what is the name for the term which we used to use for the process of eliminating or reducing risk? What is the name of the term? Method. What is the name of the method called eliminating or reducing risk? It's not transaction risk. No, actually it's hedging. Hedging methods. Hedging means the process of reducing or eliminating risk. We are hedging only transaction risk, not economic risk, neither economic risk nor translation risk. In FM, we are hedging only transaction risk. Remember, that's a exam point actually. You need to understand that we are hedging only transaction risk, neither we don't hedge economic risk or translation risk in the paper financial management. Anyway, there are 2 kinds of hedging method in Forex, foreign exchange. There are 2 kinds of hedging method. What are the 2 kinds of hedging methods? Ravin, can you say? Or Niranjana? What are the 2 kinds of hedging method? Internal and external. Okay. There are 2 kinds of hedging method. One is internal method. Internal means we can do it in the company itself. Okay. We don't want the help of any other people. We can do it by ourselves. Okay. Actually, there is a comedy in there was a comedy scene in Malayalam movie. It's a movie called CID Musa, in which guy tried to pull the car by his own, then he would say, I don't want anyone else to pull this car. I myself can pull this car. So it's something like that. Okay. Internal method is something like that. We don't want any other guys to help us. We can help ourselves. That's internal method. Okay, which we can do internally in the company itself. Okay, can you name? There are certainly there are 6 or 7 methods. Can you name any one internal method? Any one internal method? Okay, I want you to comment the internal methods. You know, there are so many internal methods. So I want you to comment some of them. Invoicing in home currency. If we invoice in our home currency, we will definitely what? We will definitely get we are not exposed to foreign exchange. So it's one of the hedging method, invoicing in home currency. But what will happen to, okay, matching receipts and payments? Okay, that's also an internal hedging method. Okay, my question is, what will happen to what will happen if we invoice in home currency? What will happen if we invoice in home currency? What will happen if we invoice in home currency? The risk will be passed to the other party. Okay, if I am providing the bill to the other guy in my home currency, then he is responsible for translation. Okay, he is responsible for the translation. So my exposure to foreign currency risk will be reduced, but his exposure to foreign currency risk will be increased. Okay, so not eliminate. Okay, we can eliminate by invoicing in home currency. Okay, we can eliminate invoicing in home currency, but the foreign currency risk is transferred to the other guy. Okay, we can eliminate for our purpose, but the risk is transferred to the guy on the other side. Okay, the company on the other side. So it's a bit difficult to invoice in home currency because whether they accept or not, it's a question whether they accept or not. Okay, that's an important question to ask. Anyhow, invoicing in a home currency is an internal method to reduce risk, foreign currency risk. So as you said, there is another method called matching receipts and payments. Okay, matching receipts and payments. So we can also match receipts and payments. Suppose we need to give $1,000 to a company, and that company is giving should give $500 to us. Okay, it's one receipt to the other company, and the companies have one payment to our company. So we can match receipts and payments. Okay, we can net off and would give 500 to the other company only. So it's like that. Okay, we can match the receipts and payments. Anyway, matching asset and liability management. It's not in asset and liability management is not hedging method in forex. It's an hedging method in interest rate risk management, I would say. Matching assets and liabilities simply like matching receipts and payments. So can you name some other internal hedging methods? Leading and lagging. Okay, leading is an internal hedging method. Leading means we are leading payments. Okay, we are giving payments earlier. Making payments earlier is called leading. Okay, lagging is also an hedging method. Lagging is also an internal hedging method. We are lagging our payments. Then netting. Netting is an internal hedging method. So what's the difference between matching and netting? What's the difference between matching and netting? Can you say what is the difference between matching and netting? What is the difference between matching and netting? Matching is simply we are matching receipts and payments, but netting is also kind of matching where it is done in a group. Okay, there will be a parent company and subsidiary company. We can simply net off the transaction between those parent and subsidiary company. That is called netting. Okay, netting off the transactions around a parent in a group is called netting. Okay, anyway, there is another internal hedging method that is not a proper hedging method. If they ask, it's not a proper hedging method, but I would like to say it in the internal hedging method. Do nothing. Okay, if you do nothing, at least the hedging cost will be reduced. Okay, the hedging cost will be reduced. It's a kind of method in which we can reduce the hedging cost. We need not do anything. The hedging cost will be reduced. That is do nothing. But if they ask us whether it's an hedging method, we should say it's not an hedging method. We can reduce the hedging method by doing nothing. At least the hedging cost will be saved. Anyhow, these all are the hedging methods. These all hedging methods, internal hedging methods, will be tested like a theory only. No calculation can be expected from this area. Okay, we cannot expect a calculation question from this area. Okay, earlier in 2012, 2013, they asked some questions in netting. Okay, no questions have been asked in matching, leading, lagging, netting, do nothing, invoicing, home currency, anything. Rather than theory questions. Okay, they will definitely ask theory questions regarding this, but there isn't any probability that a probability of a calculation question coming from this area. Anyhow, these all are the internal hedging method. There are certain external hedging method. External hedging method. Okay, there are 5 kind of external hedging method. So anyway, what do we mean by external hedging method? External hedging methods means we are hedging by the help of some external factors, external companies. It's like we can hedge using bank. One is bank and one is stock market. Okay, there are two kind of financial institutions, or I would say two authorities, either bank or stock market, which help us to reduce or eliminate risk. So what are the name given to? What are the name given to the contracts in bank which help us to reduce risk? That is a name used to Name used for the contracts. Okay, what is the name of the contract in bank? Not forward contract. Forward contract is only an it's only an external hedging method. I am asking about what is the name for the external hedging methods that is done with the help of bank. It's called over-the-counter contracts. It's called OTC, over-the-counter contracts. If you are doing the external, if you are doing the hedging using bank, then it's called over-the-counter OTC. If you are doing it through stock market, then it is called ETC, exchange traded contracts. Okay. So there are 5 important external hedging methods which are done either through bank or through stock market. Okay. Can you name them? What are the external hedging method? One you have already told, it's forward contract. You have already told it's forward contract. Okay. Then next one, which are all the external hedging methods? One is definitely forward contract. Money market hedge is there. I would like to mention it in the 5th place. Money market hedge. Okay. Then only forward contract and derivatives. Okay. What are the derivatives now? Please say which are all the derivative futures. Okay. Futures, options, then swaps. Okay. These are the 5 types of external hedging methods which are done either through bank or stock market. Anyway, I would like to ask a question. Which among the following 5 external hedging methods is used for long-term hedging? If you want to hedge for a long term, which among the 5 methods is the most useful? It's nothing but swaps. Swaps is used to hedge in a hedge for longer term. Okay. Other all methods are used for shorter term only, comparatively shorter term. If you want to hedge for a longer period of time, then swap is the best option. Anyway, among these 5 methods, only 2 area will be tested as calculation. It is forward contract and money market hedge. These 2 areas, these 2 topics only will be tested uh, like a calculation question. Other 3 areas, futures, options, swaps, will be tested like a theory question only. Okay, only theory question will be asked from these 3 areas. Anyway, forward contract and money market hedge can be asked in a calculation question. Okay, forward contract is nothing but locking. It's a kind of locking a specific rate for a certain period. Okay, it's called forward contract. Okay, we are locking. Anyway, let me ask you one thing. Whether do we have obligation in forward contract? Whether we do have obligation in forward contract? Is there any obligation? Is there obligation in forward contract? Like we should buy for this rate. Is there any like that? If is there any obligation in forward contract? Yes, there is an obligation. We must need to exchange in the specific rate. Okay, mentioned in the forward contract. It's a contract that will be with a bank. A contract with the bank in which we must be we do have an obligation that we must exchange with the specific rate. It's called forward contract. It's done through bank. Forward contract is done through bank, while futures, options, swaps, etc. are done through stock market. So forward contract is ETC. Sorry, OTC, over the counter. It's over the counter. Okay, it's over the counter because it's done through bank. While futures are done through ETC, it's like a stock market. It's done through stock market. It's also like fixing a locking a specific rate, but it's done through stock market only. ETC. Options can be ETC and OTC. ETC and OTC. Is there any obligation in options? Could you please say, is there any obligation in options? No, there is no obligation in options. It's an option. We can either opt or else we can either exercise the option or else lapse. So there isn't any obligation. In forward, we do have obligation. In futures, we do have obligation. But in options, there is no obligation. But we do have the right. We do have the right, but there isn't any obligation. Okay. In options, there isn't any obligations. Okay. So it's options can be done through bank and stock market as well. It can be done through stock market, that is ETC, and it can be done through bank, that is OTC. Okay. So in options, we don't have obligation, but we do have the right to exchange, but we don't have the obligation. It's not like you must exchange by this rate. There isn't any obligation. We can either exercise or lapse the option. It's up to us. Okay. Then I would like to ask you a question. I would like to ask a true or false question. Okay. Just mention whether the statement I am making is true or false. Okay. So the statement is we need not pay premium if we lapse the option. We need not pay the premium if we lapse the option. Is it true or false? We need not pay the premium if we lapse the option we took. It's false. Okay. We should pay the premium if we participate in the option. Okay. Anyhow, whether it get lapsed or whether we exercise, anyhow we need to pay the premium. Okay. Whatever the final result, we need to pay the premium in order to participate in the option. Okay. So if you are doing the option, we need to pay the premium. Okay. There isn't any questions like whether we exercise or lapse. We need to pay the premium. Okay. Swaps are done mainly through OTC. They're OTC, over the counter contracts. They are used for long term hedging. It's interchanging. Okay. They are interchanging their currency. It's called swaps. Okay, we know that in football there are player swaps where they interchange players. It's like if we interchange currency, then it's called interchanging. Which interchanging currency, it's called swaps. Okay. Then money market hedge. Money market hedge is a bit a tricky one. Okay, mainly earlier the students always do have doubts regarding money market hedge. Everyone says it's too difficult. Everyone says money market hedge questions are too difficult, but money market hedge questions are easy if you learn. If you learn properly, it would be easy, but you need to understand the concept behind it. There will be two kind of question that can be tested in money market hedge. Only two kind of question. Okay, what are the two kind of question? Two kinds of question that will be tested in money market hedge. Can you name them? What are the two types of question that can be tested in money market hedge? Receipts and payments. There are two kinds of question. One is receipt and the other one is payments. Okay, receipts and payments are the two kinds of questions that can be tested in receivable and payable. That can be tested in money market hedge. Only two kind of question. You need to study both of these two kinds of questions. There are certain number of questions in your exam kit and in your exam kit and in your study hub also. There are number of questions you need to study that. I'm not going to discuss now. Hopefully, maybe if we get time, we will definitely discuss receipts questions regarding money market hedge. Anyway, these are the 5 types of external hedging methods. So we do have some theories also regarding the chapter foreign exchange risk. Some theories. Okay, can you name a theory that you have learned in foreign exchange risk management? There is an equation also regarding those theories. There are equations also regarding those theories. What are the theories? What are the theories that you learn in foreign exchange risk management? Okay, if I write here, you will be definitely knowing that. Okay, anyway, it's called purchase power parity theory. Purchase power parity theory. It's an important theory in which it says it's theory based upon one price in economy theory. Purchase power parity theory, it's derived from a theory called one price in the economy. Okay, I would definitely like to give an example regarding the same. Okay, suppose the current India USA exchange rate is rupees around rupees 85 per dollar, right? The India USA exchange rate is rupees 85 per dollar. Okay, so according to purchase power parity theory, we need to get the same amount of goods. Okay, maybe grocery. Let's take an example of a grocery. Whatever the grocery we can buy with 85 rupees, that much grocery should be available in USA within $1. Okay, it's called purchase power parity theory. Purchase power parity theory says that every product should have same price in all economy. Okay, whatever the product that we can buy with 85 rupees, that we should get the same product in USA with $1. Okay, that is what purchase power parity theory teaches. But unfortunately, we don't get the same goods with 85 rupees in India and $1 in USA. Okay, suppose we will get a tea. Let's take an example of a tea. In India, it's only rupees 10 for one tea. It's only 10 for one tea. But in USA, it will be around $0.5. Maybe, I don't know. Let's take $0.5, which means it is nearly 43 rupees in India. So the theory itself is wrong. Okay, theory itself is wrong. Purchase power parity theory is technically incorrect because the price of goods is not the same in every country. Okay, we don't get rupees 85 worth goods in USA compared to India. $1 in USA, we don't get that much of grocery as we get in 85 rupees in India. Okay, we don't get for $1. Okay, that's a difference. Anyhow, purchase power parity theory, it's not technically, it's have its own limitation. Okay, anyway, next one will be much more practical. It's called interest rate parity theory, IRPT. You need to study purchase power parity theory equation. It will be given in your formula sheet, and you need to study the limitations of purchase power parity theory. Anyhow, you need to also need to study interest rate parity theory. And there is one more theory called expectation theory. You just learn it. I would like to mention those theories. I don't have time to explain all those theories. You need to study expectation theory. You need to study Fisher effect and international Fisher effect. Fisher effect and international Fisher effect. Okay. Both these theory you need to study. Okay. Anyhow, I would like to ask, what is the equation to calculate? What is the equation to calculate? What is the equation for Fisher's formula? What is Fisher's formula equation? Farzin Sheikh, could you please unmute and say what is Fisher's formula? Farzin?
1 plus r into 1 plus h.
Yeah, it's not 1 plus r. Okay, could you please tell me the full equation?
You need with the abbreviation like with the name?
No. Full equation I want. 1 plus r into 1 plus h.
1 plus r into 1 plus h.
1 plus I equals 1 plus r into 1 plus h. Okay. Then could you please tell the abbreviations?
I stands for the nominal rate.
I stands for the nominal rate. R
stands for the real rate.
And
H stands for general inflation.
H stands for general inflation. So it's called Fisher's formula. Okay, right? Do you know the theory behind the equation? How does this came? What's the real concept behind this equation? Do you know? Fazin, I don't want you to tell me whether you know or not the concept behind this equation.
No, actually, I feel I just know that with inflation, your nominal rate starts getting higher, but in every country, your real rate will be constant.
Okay.
I just know.
Okay. Do you want me to explain the real concept behind this? If you want, I would like to. But it won't be asked in the exam. But if you learn it, it will be really good. Do you want me to explain or not? It won't be tested in your exam. I can explain the concept, but it won't be tested in your exam. But it will be helpful for you to know the reality. How does this equation came? Okay. Anyhow, okay. Let's discuss it later. Anyway, we would discuss it later. Anyway, now I'm going to tell this is only an this is the equation to calculate what Fisher's formula. This is Fisher's formula. It's also tested in investment appraisal. It will be tested in investment appraisal and foreign exchange risk as well. Okay, there is purchase power parity theory, interest rate parity theory, expectation theory, Fisher effect, and international Fisher effect. And there is also a theory called four-way equivalence. Four-way equivalence. Okay, the four-way equivalence state that we do have equations for purchase power parity. We do have equation for IRPT. We do have equations regarding expectation theory and Fisher's effect. And all of the equation will be same. Okay, will be equal. All the equation will be equal. And the theory which states all the equation will be equal is called four-way equivalence. It's not four, it's four. Okay, the four, number four. Four equivalence. Both four ways it will be equal. All the equation for the above will be equal. It's called, the theory is called four-way equivalence. Okay, the theory in which it states that all the above equation will be equal is called four-way equivalence. Okay, you need to definitely study purchase power parity theory equation and interest rate parity theory equation, which is given in your formula sheet. Anyhow, if you if you if you can learn all these things, I have mentioned above, if you are able to learn, you will definitely get full marks. Okay. Anyhow, one more thing is there, I would like to explain. Okay, earlier we had already I had already mentioned it, but I would like to add some more points to it. Okay, let's consider, is there anyone's father working abroad here? Is there anyone's father working abroad? Either Farzeen, Niranjana, Revin, anyone's father working abroad? No, right? Okay. Suppose let's take again we can take a boy named X. His name is X. So his father is working in UAE. His father is working in UAE. He will definitely send him 5,000 AED per month. We have already discussed this scenario earlier, but I'm going to tell you again. Okay. He will send 5,000 dirhams. Whatever happens every month, he will send 5,000 dirhams to his son named X. Okay. The current India UAE exchange rate is 24 rupees per AED. Rupees 24 per AED. This is the current India UAE exchange rate. Okay. Suppose you need to think on the perspective of X only. Okay. Will X receive more money? Okay. Currently, he is receiving 5,000 AED, which he can convert to Indian rupees, and it will be around 5,000 into 24. Okay. He will receive 1,20,000, right? Okay. This is the current India UAE exchange rate. Suppose the UAE, the Indian currency strengthens. The Indian currency depreciate. Indian currency depreciate. I mean, Indian currency is going to get it getting weaker. So Indian currency is getting weaker, so that now the India UA exchange rate will become rupees 25 per AD. Okay, this is Indian rupees is getting weak here now. Earlier it was 24. We need to give only 24 rupees for 1 dirham. Now we have to give 25 rupees. Our Indian currency is getting weaker. Okay, so our Indian currency is getting weaker. Anyhow, his father it won't affect his father. His father will send only 5,000 dirhams. No, his father will send only 5,000 dirhams. It won't affect his father whether the Indian currency get weak or anything. But what will happen to X? Will X receive more money or less money? If the Indian currency get weak, will X receive more money or less money? Kindly comment. What will happen to the amount that X receives in rupees? Okay, if the Indian currency get weaker, more or less. Currently, he receives 1,20,000. If it goes to 25 rupees per AD, will he receive more money? Will he receive more money? He will definitely receive more money, right? More money, because now it's earlier it was 24 rupees, now it's 25 rupees. 5,000 into 25 will receive. So you need to understand that if it is receivable, just write it down. If it is receivable and home currency goes down or home currency get weaker, okay, if it is receivable and the home currency get weaker, okay, then our company will definitely make profit gain out of it. Okay, if the home currency get weaker and it's a receivable, then our company will make a gain out of it. Even though our currency is getting weaker, if it is a receivable, we will definitely make a gain out of it. Will the father make a gain out of it? Will ex-father make a gain when the Indian currency become weak or strong? Will he make any gain? Please comment. Will the father make any gain if gain or loss? Okay, gain or loss if the Indian currency gets weaker? Please do comment. Please do comment. Will he make? Don't think too much. Okay, just simply it's like a funny question. Will he make gain if the Indian currency get weaker? Please comment. Please comment. Will he make any kind of gain or loss if the Indian currency becomes weaker? Please comment. I want you to answer. You can be wrong, but try to answer. Try to attempt it. No, he won't make any gain or loss because he will be sending the same 5,000 rupees only now. So if the home currency gets weaker, if the no effect it's actually if the home currency gets weaker, then if it's a receivable, then our company will make a gain, and the opposite company, okay, it's like the opposite company will not have any sort of effect. They will send the same amount only. They are sending their currency, they will send the same amount only. Our currency, we will get a gain out of it when our currency becomes weaker if it is receivable. Okay. Then what will happen if our currency strengthens? Our currency strengthens. That is, we get only rupees 23 per AED. For 1 dirham, we will get only 23. For 1 dirham, we need to give only 23 rupees, so that our currency is getting stronger. In this case, our Indian currency is getting stronger because we need to give only 22 rupees per AED. Indian currency is becoming stronger. So when the Indian currency strengthens, I mean this is appreciation. If Indian currency appreciate, the father will send only 5,000 dirhams. He will send only 5,000 dirhams irrespective of the exchange rate movements. So if the Indian currency strengthens, it won't affect the other company. Okay, our company will be affected. Will we receive more money or less money? Will we receive more money or less money? Less money only. Okay, earlier we received 1,25,000. This time we will be receiving only 5,000 into 23. It will be around 1,15,000. Okay, we receive only less money because our Indian currency is strengthening. Okay, we should not be happy that our currency is strengthening because we receive only less money. Okay, we should not be sad that our currency is weakening because we are receiving more money. Okay, anyhow, father won't have any effect irrespective of the strengthening or weakening. He won't have any effect. Will not affect the other company. Only we do have the effect. Okay, only we do have the effect. So it will affect us only. Okay. So in this case, when the company, it's a receivable now. It's receivable. We are receiving money. So when our home currency weaks, we will get weaker. We will make gain. When our home currency gets strengthened, then we will make loss. Okay. If it's weak, then we make gain. If our home currency strengthens, then we make loss. Anyhow, it won't affect. No effect for the father. Father won't have any effect. Whatever happens. Okay. Whatever happens, father won't have any effect. Father won't have any effect. Okay. That is what we learn in this strengthen and weaken. It's just the opposite. Just think about the opposite. What if it is payable? Okay, what will happen to if it is payable? If it is payable, then what will happen? If you are sending money to our father every month, we are sending 5,000 dirhams to our father, then what will happen? Think that way. You need only to think. Always students make wrong answers by thinking too much. Just think about the common scenario. It's only a common scenario. A father sending money. It's a common thing in our native places. So we need to think about these common things only. Don't need to think about very much huge examples or something. We need to think light examples. That is what makes us easy for our exams. Okay. Anyway, this is the strengthening and weakening example. So we have discussed it, chapter 1 of foreign exchange risk, which is called forex. Chapter 1 of risk management, which is called forex. Okay, we have discussed it forex. Now we are going to move into interest rate risk management. Interest rate risk management. Okay. Then my question is, whether do we have interest rate risk if the interest goes down? Do we have interest rate risk if the interest go down? Please comment. When will you have interest rate risk, whether it goes up or down? My question is, when will you have interest rate risk? Is it only when it goes up? Please comment. Do we have interest rate risk when it is going up only? No. Even if it goes up or even if it goes down, we do have interest rate risk because as a company, we will definitely have loans, I mean borrowings, and we will definitely have deposits. So if if we do have loans, then we do have interest rate risk when the interest goes up. Okay, when the interest rate rises, we do have interest rate risk. And if it's deposit, we do have interest rate risk when the interest goes down. Okay, so we do have interest rate risk when the interest goes up and when the interest rate goes down. It's called interest rate risk, and we do have interest rate risk when it goes up and also when it goes down. Yeah, we do because we have both loans and deposits. We do have borrowings and deposits. Anyhow, there are 3 theories which you need to study in interest rate risk management. They are, one is basis risk. Yeah, it's actually interest rate risk management is a theory chapter only. Only one question, except one question. All other topics are theory. Only one question can be tested as a calculation, and it is FRA, forward rate agreement. Only forward rate agreement can be tested in interest rate risk management as calculation. Okay, otherwise, apart for forward rate agreement, interest rate risk management is a theory chapter, complete theory chapter. I can guarantee you, no other questions will be asked as a calculation. Only forward rate agreement will be asked as a calculation from interest rate risk management. Okay, anyway, basis risk. Okay, what do you mean by three theory you need to learn? One is basis risk. One is basis risk. What do you mean by the term basis? What do you mean by the term? First, can you say what do you mean by basis? Could you please unmute and say? Could you please unmute and say?
You are
What do
saying
you mean
about
by
or just basis,
what do you mean by the term basis?
which will be at least minimum risk. I would say minimum risk.
It's not minimum risk. There is a specific answer actually. Okay, minimum risk. It's not wrong, but we do have a specific answer for basis. Basis is something like the difference between future rate. Okay, the rate of future rate. It's an important topic, right? It's an important topic you need to learn. It's the difference between the future rate and the spot rate on a specific date. On a specific date, due to which basis is the difference between future. Okay, future rate of a uh, future rate of an underlying asset and the spot rate of an underlying asset on a specific date. Okay, it's a difference between future rate and spot rate, and it's called basis. The difference is called basis, and the risk regarding the difference. Okay, the risk that arises due to the difference is called basis risk. The difference between future rate and spot rate of an underlying asset on a specific date is called basis, and the risk arising due to the difference is called basis risk. Okay, so anyway, uh, due to this difference, our hedging will become imperfect. Due to basis risk, we do have imperfect hedge. Our hedging will go wrong. So due to the difference between future rate and spot rate of an underlying asset on a specific date, our hedging will become wrong, so that it will become imperfect. So due to basis risk, our hedging becomes imperfect. Okay, so it's called basis risk. Anyway, then next topic will be gap exposure. Okay, gap exposure means as a company we do have both interest paying liabilities and interest getting assets. Okay, as a company we do have as a company we do have both interest paying liabilities and interest getting assets. Okay, suppose uh, suppose if there are more assets, more interest getting asset, then it's called positive gap. Then it's called positive gap. In our company, if we do have more interest getting asset than interest paying liabilities, then it is called positive gap. Okay, then you can just simply say if there are more liability than asset, then what will be the name for that? If the asset is more, then it is called positive gap. What will be the name for if the liability is negative gap? Okay, really good. Negative gap. It's negative gap only. Okay. So if the assets are more, then it is called positive gap, and if the liabilities are more, then it is called a negative gap. Then my question is whether in which situation we do have interest rate risk? In which situation, whether in positive gap or negative gap? Sharip, can you comment? Can you please unmute and say whether we do have interest rate risk in positive gap or negative gap? Which one will we have? Will we have interest rate risk? Sharip, could you please unmute? You can be wrong, but no problem. You can try. You can attempt it. No one is perfect. Even you or even me, anyone. No one is perfect, I know. But you can always attempt. Don't worry. Sharip, can you unmute and say?
Sir, interest rate risk will be in both the gap, I guess.
It's really good. Fantastic. In both the gaps, there will be interest rate risk because in positive gap, we do have more deposits, right? Than loans. We do have more deposits. In negative gap, we do have more borrowings. More borrowings. So I have already told you that if there are borrowings and if there are deposit, we do have risk regarding interest rates. Both cases we are having interest rate risk. Okay, if it is positive gap, if the interest rate goes down, more deposit now. If the interest rate goes down, we get really less interest. So it will affect our company. So we do have the risk. Even if it is negative gap, we do have the risk. We do have more loans, more borrowings. So that if the interest rate goes up, then what will happen to our company? We need to pay more interest. So it's a risk for us. That is called gap exposure. Gap exposure is simply but the difference between the assets and liabilities. It's the difference between the assets and the liability. Okay. Anyway, we can do a few questions, right? It will be really fine if we can do some questions. Okay. I will be if you are a lender, then lower interest rate will okay. Yes, fine. If you are a lender, then lower interest rate risk will be affected. Really good. Okay, we can do some questions now. We can do. Let me take the kit exam kit. Is the screen visible to you? Please comment. Is the screen visible to you? So the question is, what is the best description of basis risk? Which one? Which is the best description for basis risk? I have already told. It's not, remember, it's not basis. They're asking about basis risk. They're asking about basis risk. Which are all the answers? Ravin, it's not C. C, they're saying fixed and floating interest. Okay. The option C, right? Okay, the option C. Okay, 2 and 4. Okay, Ravin says it's 2 and 4. Then let me ask you, is the first statement right or wrong? Is the first statement right or wrong? Is the first statement right or wrong?
It's wrong, sir.
Why it is wrong, Sharif? We need to.
Sir, basis risk is something we cannot hedge, but we can hedge the difference between spot exchange rate and currency future exchange rate.
No, actually, it's not the. You were right. It's not the correct description. But this is what we can call basis. It's only the definition for basis. The risk regarding the difference. Okay, there is a difference. Then the difference is called basis. They are asking what is basis risk. Okay, if there is a difference between spot rate and for future rate, then that is called basis. And the possibility of that movement, the possibility of a basis occurring is called basis risk. So this is not the definition for basis risk. This is only the definition for basis. And so this is the difference for basis risk. Sorry, this is the description for basis risk. This is the best description for basis risk. First one is only basis. This is the description for the possibility that movement occurs. Okay, the possibility is called basis risk, not the difference. The difference is called basis only. The risk is the possibility of that basis occurring. Okay, then this is basis risk. And then I have already told, due to the difference between spot rate and future rate of an asset, there will be imperfect currency future hedge. The hedging will become imperfect. So both 2 and 4 are the right answers. Both 2 and 4 are the right answers. Okay. Anyhow, okay, this one will be really easy for you. They're asking which two of the following derivative instruments are characterized by standard contract size. Okay, I forgot to mention that all the derivatives or all the instruments, derivative instruments, which are done through stock market, I mean ETC, are standard size. Okay, we cannot customize those ETC. So please mention whether these are ETC or OTC, which means whether these are done through bank or stock market. Is forward contract done through bank or stock market? Is forward contract done through bank or stock market? Please mention. Bank. Forward contracts are done through bank, which is called OTC, over the counter. Whatever that is done through bank or OTC will not be standard sized. Only ETC contracts are standard sized. And forward rate agreement is also through bank. It's also through bank, that is OTC, over the counter. Okay. Anyhow, future contracts are done through stock market. Okay, they are ETC, exchange traded contract. Swaps are done through bank. These are done through bank, that are OTC, over the counter contracts. And there are two options. One is exchange traded ETC options, and one is over the counter OTC options, which is done through, this one is done through bank, and this one is done through stock market. Anyhow, all those are done through stock market are standard sized. Here only future contracts and exchange traded contracts are ETC, that are done through stock market. So the answers are C and F. Some among you have already mentioned. The answers are C and F. Okay. This one will be really easy for you. What is the best description for gap exposure? What is the best description for gap exposure? Which of the following is the best description for gap exposure? Which is the answer? I think you might have gone through the answers already. Okay, B. Because it is the difference between interest sensitive assets and liability. I have already told you, if the assets are more. What is the gap called if the assets are more? Please mention. What is the name for the gap if the assets are more? If there are more assets, then sorry.
Positive gap if the assets are more than the liabilities.
If the assets are more than the liability, then it's called positive gap. If the liabilities are more, then it's called the negative gap. Okay. Anyhow, gap exposure is the difference between both assets and interest paying assets and interest getting assets and interest paying liabilities. So B is the right answer. Okay. Then okay, this one will be C. Okay, they're asking about over the counter interest rate options. Over the counter, they are done through bank. Okay, over the counter means they are done through bank. So whether the first statement is correct or not, option 1, it's an agreement with financial institution. Is it right? Over the counter. First statement is definitely right because it's done through bank. Over the counter, right? Over the counter means something done through bank. Bank is a financial institution, not like the stock market. Okay, it can be traded. Over the counter options cannot be traded. Only exchange traded options can be traded. Okay, it must be exercised. It must be exercised. We should exercise. Option itself. The name itself says there is an option. We need not exercise. We can also lapse it. So it must be exercised. It's a wrong statement. So I would like to make a little change to this statement, and I want you to say the answer whether this statement is true or false. I would say it can be exercised. Is it true or false? Options can be exercised. Is the statement true or false?
True.
True. Options can be exercised, but we need not. It's not necessary. It's not mandatory. We can exercise, but it's not mandatory. So anyhow, this statement is wrong. It must be exercised. It's not mandatory. An immediate premium is payable. I have already mentioned that we must pay the premium irrespective of our decision. Whether if we lapse or exercise, we must pay the premium. So this statement is correct. Okay. Okay. Anyhow, I would like to give you a easier one. Okay. We will discuss one more theory. Then we will come back and do a few more questions, right? We will come back and do few more questions. Anyhow, the next theory will be yield curve. Next theory will be based on yield curve. Okay. Yield curve is a relationship between two things. What are the two things which will be shown in the yield curve? What are the two things which will be shown in the yield curve? Please kindly mention the two things that will be shown in the yield curve. What are the
Time
two
and
things?
interest rate.
Time and interest
Interest
rate.
rate.
Or else we can say time and time means maturity, and interest rate means yield. So
Returns.
returns. Okay, so yield curve is a relationship between both time and returns. Time and return. So I would like to provide you a graph where in x-axis I would mention the time, or else it is called maturity. Time, or we can call it maturity. Okay, in y-axis I would like to mention return, or else you can say yield. Okay, what is the shape of normal yield curve? What will be the shape of normal yield curve?
Upward sloping.
It's an upward slope. Very good, Fazin. It's an upward slope. Because if we invest for longer period of time, we will get more money. If we invest for longer period of time, we will get more money. And probably in normal cases, the shape of the normal yield curve is upward slope only. If we invest for longer time, just see that as the time increases, our returns is also increasing. Our yield is also increasing. Okay. So if we invest for longer period of time, we get more returns. Okay. So the normal yield curve is upward slope, but in certain situation, it can be flat, it can be inverted, which means downward slope, like the recessions and all. At the time of recession and at the time of economic fall, it can be both inverted or else it can be slope. But in the normal scenario, it is upward slope. Okay. Anyhow, the shape of the normal yield curve is upward slope. There are three theories which determine the shape of yield curve. Can you name any three theories? Can you name any three theories? Not any three. There are three theories which determine the shape of the yield curve. Which are the three theories? Anyone? Any one theory? Liquidity theory. Very good. One is liquidity theory, liquidity preference. Then, sorry, expectation theory. One is liquidity theory. One is expectation theory. And the other one, market segmentation theory. Very good. I think you have already attended my class, my Malayalam class maybe. I've already mentioned in the Malayalam class. Or else the faculty teaching you would be really nice. Normally students won't answer this very much. Okay. The third one is market segmentation theory. Anyway, these are the three. This will be tested. This can be tested. So there are three theories: liquidity theory, expectation theory, and market segmentation theory. Liquidity theory state that everyone prefer liquidity, right? We also prefer liquidity rather than profitability. Okay, we do prefer liquidity rather than profitability. Anyhow, in order to compensate that, okay, if you are giving the cash for longer period of time, we are actually sacrificing our liquidity, right? We are sacrificing our liquidity. We are giving the cash for longer period of time. So in order to compensate that, they need to give us more returns for investing in longer period of time. So we are sacrificing liquidity when we are investing for longer period of time. In order to compensate that sacrification, they need to provide us more returns when we invest for longer period of time. Okay, that's why the shape of the normal yield curve becomes upward slope, because as the time increases, the returns also increases. Anyway, then the next one, expectation theory. Normally, people do have expectation for their interest rate. They need more interest when they are investing for longer period of time. They do have expectation regarding the interest rate. In order to satisfy their interest rate expectation, we need to provide more returns for longer period of time, which is called expectation theory. And market segmentation theory. The entire stock market is divided into two segments. Not the stock market, the entire market is divided into two segments, and the one segment is short-term market and the other segment is long-term market. Okay. Most of the people prefer liquidity over profitability, so that there will be more people in short-term investment. Okay, let's take an example of a bank. There are more savings account than FD account, right? So people always prefer liquidity, short-term investment. I mean liquidity, so that they need short-term investment rather than long-term investment. There are more people in short-term investment and less people in long-term investment. In order to make them satisfied. Okay, there are only less people now. In order to make them satisfied, the less people, the minority people, we need to give more returns to the minority. Okay, we get only less money in long-term investment, so that we need to give them more returns. It is called market segmentation. The entire stock market is divided into two segments. Okay, there are different kind of people in both segments, right? So in order to satisfy their segments, in order to satisfy the less people, the minority, the long-term investors should be given more returns, right? The long-term investment should be given more returns. Anyway, we shall do few more questions. Okay. So the next question is, which of the following is shown by yield curve? Which of the following is shown by an yield curve? Which is the right answer? There are 4 options. Which is the right answer? What is shown by a yield curve? B. Yeah, right. It's the time. It's the relationship between time to maturity and returns. Time we can call maturity and returns we can call yield. Okay, it's a relationship between time and maturity. Okay, anyway. This one will be really fantastic. Which of the following statement is correct? Is correct. I would like to ask the fourth one. Is the fourth statement correct or not? Is the fourth statement D? Is D option correct or not? Option D. No. D option is not correct because expectation theory say that future interest rate reflect expectation of future inflation rate, not future inflation rate. They do have expectation regarding the future interest rate, not inflation rate. Okay, interest rate. So the statement is wrong. Okay. Anyway, let's take option A. Is the statement correct or not? Could you please mention whether the statement correct or not? Farzin says it's correct. Okay. Anyway, let's check. Let's check. Government may choose to rise interest rate. Government will increase interest rate so that the level of general expenditure in the economy will increase. The amount people make expenses, okay, the amount people spend will increase if the government increases interest rate. Is the statement true or false? It's wrong. It's wrong actually. Okay, it's wrong because if the government increases interest rate, people won't take loans, right? People won't take loans. They won't pay EMIs. They won't buy things. So the general expenditure will decrease if government increases interest rate. If government increases interest rate, people will spend less amount of money. So that general expenditure will go down. They says the general expenditure in the economy will increase. It's wrong. The statement is wrong. So this is wrong. Option A is wrong. Anyway, let's take option B. The normal yield curve slope upward to reflect increasing compensation to investors for being unable to use their cash now. Is the statement correct? Is the statement right or wrong? Yes, it's absolutely correct. I told you that the shape of the normal yield curve is upward slope because people are sacrificing their liquidity in order to compensate that sacrifice. They need to be provided with more returns when they invest in long term. Okay, so it's an upward slope because they are providing compensation to those who sacrifice liquidity. So it's an upward slope. So this is the correct answer only. Anyhow, let's take next one. Already we got the answer. Anyhow, let's take next one. The yield on long-term loan is lower. I've already told you, is yield on long-term loan is lower? Is yield on long-term loan is lower? Please mention whether yield on no, it's higher. Okay, yield on long-term loans is higher. This one is higher. Okay, the yield on short-term loans are the short-term loan notes are probably is lower. Okay, if the yield on high means yield on long-term loans are higher, yield on short-term loans are comparatively lower. Anyhow, this is it's lower. Anyhow, this is not answer. This is not the correct answer. Our correct answer is option B. Our correct answer is option B. Okay. Okay, fine. Next one. 206. A UK company to enjoy the benefit of favorable change, they need to take the benefit of a favorable movement, which is there is forward contract and there is option. Two kind of options. Anyway, let's take options. And there is money market hedge. Okay. Which one will provide them the benefit of favorable movement? In which one they can enjoy the benefit of favorable movement? Which one will be the correct answer? Options. Okay, options are the correct answer. There is two kind of option: put option and call option. Okay, this is a question of receivable. They are receiving UK company. What is the currency in UK? First of all, what is the currency in UK? You need to know that. What is the currency in UK? Is it euro? Is it euro? It's pounds. Okay, euro is the currency in Europe. It's a European. It's a currency in European Union only. Pound is the currency in UK. A UK company is gonna receive euro, so they need to sell euro. They will receive euro now, so they need to sell euro, which means they should select the option for selling. Okay, they need to select the option for selling. Call option is nothing but buying. This is not nothing but buying. Put option is selling, so they need to take the option for selling, which is the option. Option B, put option is the right answer. Okay, they will receive euro now. They will receive euro, so they need to sell the option to sell euro. That is put option. That is put option. Yeah, this one will be really fine. Which of the following theories does not influence the yield curve? Which is the theory which I already mentioned, which is the theory which will not affect the yield curve? Option C, flat yield theory will not affect the yield curve. Okay. All other theory, liquidity preference, expectation theory, market segmentation theory will affect the yield curve. Okay. Which of the following statement is true of a put option? Which among the following statement is true about the true about put option? Okay. Anyway, put option, I have already told put option is something regarded to sell. Okay. So only option A and B can be right. Okay. It's not buying. It's buy. If it is buying, it is called call option. So option C and option D are wrong. Anyhow, options we don't have any obligation. So that option B is also wrong. Okay, in option we have the right, so that option A is correct. So option A is correct. There is in any obligation, and put option is means that it's the right to sell, not the right to buy. So option A is correct. This one will be easy for you. The difference between price of a future contract and spot rate on a given date is known as dash. The difference between future contract and spot rate. I've already mentioned the answer. What is the difference? It's called basis. The difference is called basis only. Fine. This one will be also helpful. Lagging is a method of hedging transaction exposure. I have already told you. No, I haven't told. Lagging is actually, even though I told in the internal hedging method, lagging cannot be considered as a proper hedging technique unless there are certain things which make it sensible. Okay, if there isn't anything which make lagging sensible, we need to say that it's not a proper hedging method. So the statement is false. Matching receipts and payments is a method of hedging translation exposure. Is this statement true? False. This one is also false because we are not studying any hedging techniques in which we are hedging translation exposure. We are always trying to hedge transaction exposure only in the paper financial management. So this statement is also wrong. Okay, there are a few more. Okay, this one will be easy. Which of the following term matching refers to? Matching refers to. Matching is nothing but we are matching the receipts and payments, right? So the mechanism whereby a company balances its foreign currency inflows, which means receivables, I mean receipts, and foreign currency outflows, which means payables. So matching is nothing but matching receipts and payments. Okay, matching receipts and payments. Okay, this one will be a tricky question. Do you want me to do this? Or else we may discuss the next topic, or else we can do this question. If you want me to do this, I will do. Yes. Anyone else? Anyone else want me to do this question, or else I would like to discuss the next topic only? Okay, I will definitely do it. A UK company. The company is in UK. Our company is in UK. Remember, our company is in UK. Has dispatched a shipment of goods to Sweden. Our company is in UK and we have dispatched our goods to Sweden. So that, is it a question of receivables or payables? Is it a question of receivables or payables? Please mention whether this is a question of receivable or payable. Our company is in UK. We dispatched goods to Sweden. So that it's a question of receivables. We will receive money. We will receive money from Sweden. So it's a question of receivables. Okay. Only that we need to know. Then we can easily do this. Okay. If the pound sterling were to weaken, our home currency is pound, is getting weaker substantially against Swedish kroner. Swedish kroner. Okay. Then our home currency weakens, and we do have receivables. I have already mentioned the example of father and a son named X. Now, if the it's receivable, father will send 5,000 dirhams. If the currency becomes home currency weakens, then he will definitely make gain, right? He's going to make gain if the home currency weakens. So here the home currency is weakening. Our country is in UK, and the home currency is weakening, and it's receivables. Whether we will make gain or loss if the home currency weakens. Whether our company will make gain or loss if the home currency get weaker. Please mention. Gain, we will definitely make gain. We are the UK exporter, and when the home currency get weaker, we will definitely make gain, because if home currency get weaker, we will get more money. If it's a question of receivables, and if the home currency get weaker, we will receive more money, and we will make gain out of it. Okay. Then what will happen to the father? Okay, let's take the example of father. In 3 cases, if the home currency gets weaker, if the home currency gets stronger, whatever happens, what will happen to the father? Okay, that father example. Remember those father example. Okay, will he make any gain or loss? What is the correct answer for Swedish importer? It's like the father. Will he make any gain or loss? Anyone? Farzin, what do you think? Farzin Sheikh, what do you think? Will the father make any gain? No effect. He will not have any effect. He will definitely, the Swedish importer will definitely pay in Swedish krona only. He don't have any effect. Whether the home currency weaken, the person who need to translate this transaction is the company in UK. Is the company in UK. The
Because the
Swedish.
sales invoice
Sorry?
in the importers currency.
Sorry, I didn't get the question.
The no effect is because the sales will be invoiced in the importer's currency.
Importer's currency. Okay. The importer's currency, the sale is recorded in the importer currency. So that the person who need to translate this amount is UK exporter. He only will be having any type of gain or loss. The person on the other side, the Swedish importer, won't have any gain or loss. That is no effect. Okay, just take the example of the father. I mentioned the example of father. Okay. So there is another similar questions. Similar question I think. This one is almost same. Okay. ED company is a UK company that imports furniture. Okay, imports furniture. They are importing furniture. So whether this is a question for payables, okay, our company is a UK company and we are importing furniture. Okay, we are buying goods. So that whether this is a question for uh, receivable or payable. This is a question for payable only. Okay, we are paying money. If you are importing the goods, then we will be paying money. So this is a question of payables. Anyhow, this is a question of payables. Just think the opposite. Okay, when it is receivables, when the home currency get weakens, we will get gain. We will get gain. When it is payables, if the home currency get weakens, then we will make loss only. If it is payable, then the pound sterling, if the pound sterling, that is the home currency now, our company is in UK, the pound sterling is home currency. When it get weakened, we will make loss only. Okay, no gain, only loss. If it is payable, if it is receivable, we will make profit. Anyhow, even if whether it is receivable, whether it is payable, the person on the other side, will he make any gain or loss? Will he make any gain or loss? Anyone? The person on the other side, even if it is payable, even if it is receivable, since it is invoiced in the in the foreign currency, gets invoiced in Canadian dollars, will the person on the other side will make any type of gain or loss? Could you please tell me whether the person on the other side will make any type of gain or loss? No, the person on the other side won't make any type of no effect for the person on the other side. No effect actually. No gain, no loss. Okay, won't make any type of gain or loss because he's invoicing his own currency. He need not he's not exposed to foreign currency exchange rate movements. Okay, the person on the other side won't be affected because he will the invoice is in his own currency, so that he need not translate. The person who need to translate is our company. Anyhow, no effect for him. Okay. Anyhow, we have came across lot of discussions. Anyway, there are certain hedging methods also. There are certain hedging methods in interest rate risk management, which is I would like to classify them to two. One is traditional methods and the other one is derivatives. Traditional methods and other one is derivative. Farzeen, what do you mean by derivatives? Farzeen, what do you mean by derivatives? Just unmute and say.
Derivatives, I feel, is the one who get their values from an underlying assets.
Yeah, very good, fantastic. Derivatives are those instruments which derive their values from an underlying asset. When underlying asset will be there. For instance, take an example of gold. Okay, there is also gold future. Okay, futures of the gold now. So the underlying asset of gold future. Okay, the underlying asset behind the gold future is gold itself. The asset is gold. If the underlying asset in the crude oil future, then it is crude oil. So any derivatives will have some sort of underlying asset in it. There will be underlying asset. Okay. Anyhow, there are traditional methods and derivatives. Derivatives are nothing but futures, options, and swaps. There are three derivatives: futures, options, and swaps. Traditional methods are those where matching, smoothing, and asset and liability management. Asset and liability management. And FRA, forward rate agreement. FRA, forward rate agreement. Only forward rate agreement question will be tested in your exam as calculation from this chapter. Only one calculation can be tested in these interest rate risk management chapter, and it is called forward rate agreement, FRA. You definitely need to study forward rate agreement question. Only you need to study FRA, right? Only you need to study FRA, forward rate agreement question. Okay. Anyway, we have been conducting our class since 10 o'clock, 10:15, or else something we started. Anyhow, we need to wind up now. We will discuss these topics. Some topics are pending. The hedging methods and the FRA, which will be asked as calculation also. We need to study that also. So we will continue later. It's Friday, so that we need to go for Juma. I will be leaving now. We will continue our session later. Anyhow, did you find the session is helpful? Ravin, did you find the session helpful? Could you please unmute and say? Okay. We will continue later. Anyway, have a nice day. Hope you are all studying good, and may God bless you. Thank you.